Welcome to Cash Flow Hacks Podcast. I am your host, Chris, and my co-host today is Stephanie.
Hello! I'm so happy to be here with everyone else who's ready to make more, save more, and live more now.
Well, you're in the right place because every week, Stephanie and I are going to be sharing some different strategies that your financial advisor doesn't want you to know.
Right. So in this episode, we are going to be interviewing Jason Byers with Allegis about how to utilize life insurance as a tax-free retirement. I've been working with Jason for a few years, and he is the expert I go to when I'm designing tax-free retirement income strategies for my clients. I'm very excited to have him here today to share with everyone his vast knowledge on utilizing life insurance policies to have tax-free income during retirement. Jason, thank you so much for being here today.
Hi, thanks for having me.
So glad to have you on the show today. So let's start at the beginning. Jason, tell us how you got started in the industry.
Well, I started about over 25 years ago, mainly with a PNC company that offered, home, auto, those sorts of types of insurance, but they also had a lifeline. And I started doing the marketing there. And, over a short period of time, I realized that, having one product for term and one for universal life just really didn't make a lot of sense. You'd have clientele come in that had, either weight issues or maybe they were looking for more of a cash value type policy. And we just didn't really fit that clientele. So, I started looking for more of the brokerage side, and I got into the brokerage industry over 18 years ago and started working for, one of the largest brokerages in the United States, and learned a lot there. You learn what products fit where and how, and that underwriting is not all the same. So that's a big one. You run into, clients that come in and they have, hard to underwrite, or they have needs that, you have to have a certain type of product to meet. But yeah, that's basically, what I've been doing is working on the brokerage side. I now work for more of a concierge insurance company, or BGA. And, we offer, over 60 carriers, and it's more of a hands-on approach, and we have time to spend with the clients and the advisors that we work with, more on a one-on-one basis.
Yeah, that's fantastic. And having access to 60, different companies, that really helps you find the best of the best out in the market for anybody that's looking to be able to access that many different companies. That's amazing.
Yeah, absolutely. I mean, in this space, you really need to, be part of an organization that can bring you, just about every company out there, because there's nuances to each of them. There's some that are better than others. And you really want to be able to offer all lines of insurance for sure.
Right. And today we're going to be talking specifically about the products that can offer a tax-free retirement. Before we talk about that, though, I want to ask you, why do you think it's so important for us to plan for this? I mean, what is the volatility of taxes?
Well, that's the big topic in the market right now. We're seeing, more and more people talk about taxes in the, future. We see tax rates going up, and you see the national debt going up, and you see the government running out of money every year, and that's got to change. And so, we really need to diversify and put your money into the three buckets, which is, tax now, tax later, or tax free. And the tax-free is really what we're going to focus on today, because that's going to help offset your tax liability down the road. Right now we're at a 37% tax bracket. And, if you look back historically, it was as high as 96% back in 1945, so it just shows you there's a lot
of... That is so high.
It is. And that just shows you that the government, there's a lot of room, they've got to move, to get to those higher brackets that we saw, back in the 40s, 37%, that's relatively low, but, it's going to be the people who, are like you and I that are going to get hit the hardest, because, if you have a 10% increase on your taxes, that's 10% less you have to spend on retirement.
Exactly. Yeah. Now, I think you had told me before, too, that it had gotten that high because of war, but that's not the only reason. Like the government, didn't you say, based on how much it had spent?
Exactly. I mean, when you start to see the spending more than money coming in situation like we've seen over the last, what, 30 years, because every year it's a big topic. They run out of money and they try to figure out ways of cutting budgets, but really where they're going to start to get the money back is increased taxes. I mean, that's really the only direction that we see. We're trillions of dollars in debt, and if you take $1 trillion and spent $31 million a year, it would take you 30,000 years to spend that amount. That's what $1 trillion is. It's a big number.
That just blows my mind. That is crazy to think about how big of a number it really is. Because when you hear it, like, we owe $3 trillion, it doesn't quite sound like that. That really puts it into perspective. 31 million for 30,000 years to get to that. Wow.
Yeah. That's a lot of money. And, the way that we look at it really, from our standpoint, a lot of people will liken it to, you go to the bank, you take out a loan for your house and you take this money out. And the bank says, we're going to tell you what the interest rate is after you pay the loan off. And we can pick any number. And that's essentially what you're doing with your retirement, is you're saying, I'll wait and pay the taxes later on it, but you don't know what that number is going to be. You would never, ever enter into a contract with a bank saying, hey, here's a 30-year loan. You took out $750,000. And when it's paid off, we'll just tell you what the rate is at that time. And that's, that's what you're doing by waiting. Yeah.
Wow. I mean, that's a really good way to put it into perspective, because you wouldn't do that. You wouldn't sign a contract that said that. But, that thought of like, okay, well, I'll defer my taxes till later. And then there's that false information that's running around. It's like, oh, you're going to be in a lower tax bracket later. I have never I hear that so often, and I'm like, that's not necessarily true. Where did you, get that from? But it's something that's just permeating in different articles and things. So it's wonderful to talk about how not only could we be in a higher tax bracket later, but our tax brackets themselves could be higher.
Exactly. And that's the thing is in our industry, that's all we're talking about. And then you look outside of that and others are, well, we anticipate, maybe taxes going down. And I just don't think that's reality because, like I said, where's the money going to come from to pay what we owe as a country? It's not going to get better. It just gets worse year over year. So, something's got to give. And I really see that being the direction, as far as, and also why take the chance?
Exactly.
If you have a vehicle you could put your money into to lower that risk or eliminate it entirely, if you really structured it right, that's the best place to be.
I agree. And that's why, we work together to help our clients with this tax-free retirement bucket, like you mentioned.
Absolutely.
You mind explaining a little bit more like how life insurance products are used to provide this benefit?
Yes. So we've got several different products you can use. Just about any life insurance really could be used for a retirement vehicle. Now, they're not all the same, and they're not all going to give you the same returns. They're not all going to give you the same loan rates. There's a lot of internal components that you really have to be careful when designing a life insurance policy for retirement. You've got vehicles like, whole life, for instance. You've got universal life. You've got indexed life. You've got variable life. Those are the kind of main ones that you're going to see out there. Then there's hybrids within those types of products, but they're mainly based off of that chassis. And really what it comes down to is I want to buy the least amount of insurance so that more of my money goes towards the investment, right?
Right.
Yeah. So what we try to do is we use the vehicles like an index life. You can do it with variable as well. And we solve for a minimum non-MEC face. That's a modified endowment contract. And what that does—
mind just for our listeners going over what a MEC is?
Yeah. A modified endowment contract is a limitation on how much money you can put in. There's testing that's built into the life insurance software that we use. And essentially it says, you can only put in X amount of dollars and buy this amount of face in order for it to stay out of what we call a MEC. And you don't want to create a MEC because if you do, let's say that we just forgot about the MEC rule and turned the software off, you get a penalty prior to 59.5 of 10%. And then you can also create tax on the distribution. And that's what we're trying to avoid. So all of the policies that we would design for your clients would be, we want to put in the most amount of premium. So if somebody came to you and said, I've put all my money into my retirement, I've maxed out my 401k, I've got this extra money sitting on the sidelines, because we wouldn't recommend you just buy life insurance for your entire retirement, but this is a nice bucket to put it into to give you this tax-free, money in the end. So what we're doing is we're solving for the least amount of insurance to buy the most in the investment. And an index product works really well for that, because we can solve down the death benefit, put the money in, say if they want to spend $15,000 a year, and then we recommend you put that money in for a set period of time, So 15 years is usually what we want to see. And that's an expectation that we want to set with the client up front, that this is a long-term, scenario.
Right.
And it's not for somebody who's coming into your office and saying, hey, I'm 68 years old and I want to start my retirement plan. They don't have the years to do it. And we'll be honest with them and say, that's just not, it doesn't fit the mold.
This isn't the right thing for you. Right.
Exactly. So, when designing these, obviously we're putting the, largest amount of money in, buying the least death benefit, and then that death benefit increases as the cash value grows. And in the end, basically what we're trying to do is create money that could come out over a period of time. So you fund it for 15 years, and then we'll pull income for, say, 20 years, So perfect example would be, I'm a 50-year-old, come into the office. I want to put $20,000 a year into this. I'm now 65, 15 years later. Then we turn it on and we'll run income from, say, 66 to 86. And then that will generate a tax-free income. And the key to the whole thing is you got to keep the death benefit in force to keep everything tax-free. Because if you pull all the money out, lapse the policy, you're going to get a tax bill. You've got to keep that policy in force till death. And so, that's why you want to come to an expert like you or us to design these, because we want to make sure that the policy does what it, is designed to do.
Yeah, absolutely. Because there can be, and there are, examples of these types of policies being set up incorrectly, and they're not going to be able to do exactly what they think they're going to be able to, and you find out too late. Right?
Yes.
So I'm always an advocate of double checking, or, having somebody else look it over. So, if anybody's listening and they have a policy like this and they would like us to look it over, we'd be more than happy to do so for them. Now, specifically, Jason, I have been getting a lot of questions about, the difference between whole life and universal life, and which one is better to design these, because of the difference of the expenses inside those types of policies. What are your thoughts on that? What is your opinion?
Yeah, I mean, you're right on. There's a lot of nuances from each product, and we'll kind of go through each one real quick and just kind of say, here's the good, bad, and ugly of each one. Okay. So you've got your universal life, which is just usually current assumption, and it's going to be set on an interest rate based on what current interest rates are, really. That's kind of what drives it. We just went into a high interest environment. So those are going to project at a higher rate. So the current rate might be 4.8%, and then it has a minimum of, say, 2%. And that's your world. So you kind of limit yourself on just a true universal life, because you've got, not a big difference between the minimum guaranteed rate and the current rate on the contract. Those are more for death benefit with some cash, but I'm not necessarily going to use that for distribution for retirement. Get yourself into whole life. And whole life is an excellent vehicle from a standpoint of, it's a set premium, set death benefit. And typically a lot of advisors will set the dividends to pay towards paid up additions. And what that means is every time a dividend credits, then it buys more insurance. Problem I see with those is the premiums are typically quite a bit higher. And unless you start getting into a lot of term blending and things that a lot of advisors don't do when they put these together for, a cash value plan, it really falters when you try to pull the money out, because typically those have really high loan rates, anywhere from 6 to 8%. And that's where you get yourself in trouble. You start pulling loans on that, and you're pulling money out at 8%, but only making 5 or 5.5 on the dividends. So you're upside down every year. And people have a tendency to pull too much out too fast, and then they run into troubles down the road. Next, you come into like an index product. And an index is going to put you in the market without the risk. Most policies will give you, say, a cap of, say, 6.5 or 7 and a floor of 0. So now your money's in the market and you have no downside risk, but you have some good upside potential. Mm-hmm. And if you have a 20-point downturn the next year, you keep what you have and it's not eroding, the money that you've made. So it's a little more steady as a vehicle. But then on the flip side, when you go take the money out, you usually have far more favorable loan rates, 2, 2.5, 3%. And so you're usually making more money in the market than you're spending out. Unlike a whole life policy, you can get upside down very easily just because the loan rates are typically higher. The next,
so if I have understood correctly, like that could happen multiple years in the whole life because of the spread between the dividends paid and the loan rate, but the market, hitting the floor of 0 is probably not going to be as consistent because it follows the market, so it's going to go up again. Is that what you mean?
That's just it. Plus, the loan rates are so much lower to begin with. I mean, if you're dealing with a loan rate of 8 versus 2.5 or 3, there's a lot more you have to make up in the market to wash that out, and keep it on the back end. Because the whole life contracts, they build, cash value, great, but you're usually putting a much higher premium in to do it in the first place. That's the other thing is, when you're looking at UL indexed or variable, we're now solving for that minimum non-MEC face that we talked about. So now we're saying you want to put X amount in, say 20,000 a year, and I'm solving down to the lowest death benefit. If I were to do that in whole life, it would force me to buy a certain amount of death benefit. I'd say 20,000 my premium and the death benefit's $1 million. And so a lot of that cost is going towards the cost of insurance. And we're trying to avoid that. Like I said, you can term blend out in whole life, but most advisors don't get into that. They usually just follow the steady, I'm going to put the money in, here's the death benefit, and it goes towards PUAs or paid up additions. So, but like I said, usually where I run into problems, I do more loan rescues on any other policy out there or any other type of contract. It's always whole life. And the reason being is expectation was, look at all the cash is in here. And then a client draws out a big chunk all at once, so they, right. I got a whole life contract. I'm going to pull out $100,000 because there's 300 in there. Now you got an 8% loan working against that 100,000 every year. And if you sit on it for 15 or 20 years, what happens? The rest of the cash value starts to erode because it's paying for that loan. And so, people come to us and go, oh no, now what do I do? And what we usually do is we do a loan rescue. We move it into a more favorable product like an index that has a more favorable loan, at 2% or something. And then at least they're not having to utilize that high loan rate that the cash value is just getting, basically eroded. And you lose a lot of your investment that way if you're not careful. We can get into variable. Variable is going to give you, I'm an investor and I want to take the good with the bad, right? So it'd be just like being in the market. If the market does 40, I get 40. If it goes negative, I lose. But the problem with that when you're building a retirement plan is it's kind of like building a brick wall. If I build a brick wall on an index policy, I'm laying my bricks and the market tanks and I just stop where I'm at, right? And then the next year it goes up and I start building my wall again. On a variable, it can be I'm building my wall and the market tanks. I have to knock half my wall down and start back at the bottom again. And then work my way back up. And so that happens periodically because the market never just says up, 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 and that's the problem you can run into when dealing with some of the variable plans. In fact, some of them are actually starting to become hybrids and adding index accounts to them because they see the benefit, especially when you start taking distributions. You don't want to have one of those years where it takes money out. You want a 0, during those years.
You don't want to pull out on top of it already being a down year.
Correct. Yeah. And that's where when you start to look at say an index, you're going to have that zero's the hero, the zero's the floor. In fact, if you go into, premium finance markets where banks are involved, the vehicles they use are always index. They don't use other vehicles, they can, but they choose not to because of how the loans work.
And that's interesting. Definitely premium financing is a topic for a different conversation, right?
Definitely. There's a lot more involved with that. So yeah, we could get out in the weeds on that, but that's, basically just breaking down each product and where they shine and where they might have some pitfalls along the way. You can use any of these vehicles for the plans we're talking about. Some are just a little more efficient than others, and some work a lot better on the back end. Some grow well, but then, where they fall apart is when you start to take your money out. And that's where you don't want it to fall apart, really.
Mm-hmm. And what would you say to the people that, for example, say that, okay, well, whole life is better because it's not a hypothetical like the index?
Well, dividends, if you're using a participating product, and we sell whole life, and I sell a lot of it, and it has a fit in the market. I mean, I usually sell it on younger clientele that are, really young, and they just want a steady product to grow cash and have an increasing death benefit, because the money or the dividends are crediting towards the paid up additions and growing your death benefit. But like I said, on the back end of it, that's usually where we see problems. And I do enough reviews, each week to know that, one product has more problems than another, in the last 20 some odd years. And it seems to be a lot of whole life. It used to be variable, but that's because they were designed improperly. But the whole life ones are seem to be the most troublesome because of the expectation that was set. So it really comes down to the advisor. If an advisor is telling the person, look, you can grow the cash and do these things, and then setting the expectation that they should take it out in maybe chunks and not all at once. And that's another way that we design the index. We're not telling somebody to put money in for 15 years and then pull it all out in 1 year. That's not going to work well for anybody. So, once again, it's here's a 20-year distribution of tax-free money that you can use to help supplement your retirement. So a lot of it is expectation, a lot of it's design, but, really the inefficiency that I see with whole life isn't the fact that the growth side of it, because dividends are relatively consistent. They've gone down over the years. We haven't seen the 8% crediting that you might have seen, in the 70s or something. It's more realistic. You're probably going to be in the 4s or 5s, where with an index product, if it has a cap of say 6.5 or 7 and the market does 20, you get 6.5 or 7. But if it tanks the next year, you still keep what you've gained. Right. So you're in the market with no risk, but with a certain cap. So that's kind of the difference really between the two. You can either put it in, say, guaranteed growth, or I'll take my chances, but not have downside.
Right. And also, like at CQ Consulting, we do a lot of non-traditional investments because we want to stay out of that market fluctuation. So being able to, take advantage of the market without the risk is, a great way to kind of get into the market, but not have, like you said, that volatility, the up and down. And if it tanks 1 year, you have zero. You just keep exactly what you had. You mentioned something that I would like to have you elaborate on. So you spoke of, the death benefit, which is the amount of money that their beneficiary would receive. Now, with these products, because they're taking the loan, how is the loan then paid off after they pass away?
Well, internally, the nice thing about life insurance is as you start to pull money out, the death benefit decreases, right? Typically. So you're pulling money off of both ends. You've got your cash value and your death benefit, and you'll see the death benefit will decrease as distributions pull off of that. So at death, whatever the death benefit is at that time is what the client's beneficiary gets, right? So if I've got, let's say I've got a policy we designed and the person was taking money out, 100,000 every year was coming out of that contract, and they get to the end and they pass away, and there's still a $230,000 death benefit left in the contract, because we always want to leave a death benefit. That's what keeps everything tax-free. Then that goes through to the beneficiary free and clear. And that's one thing that just normal investments don't have, right? Because if I invest in the money, I just have the money plus interest. And if I die, that's all they get. But if I'm earning, or putting money into a life insurance policy, and I don't get to the point of where I take distributions, or I don't take any loans, or I don't do anything on it. And when, just say I get hit by a car or something while I'm trying to earn money for our retirement for the family, and I die, then there's a death benefit there that's always much greater than whatever the cash value is. It always has to be higher than the cash value, or it's not life insurance.
Exactly. That is a great point. And so when, our listeners are thinking about it, if, they don't already have it, it's a great thing to get if they want to have tax-free income in retirement and, like you said, leave the death benefit to their loved ones. Who else would you say that this product is really good for?
It's crazy.
You mentioned not being 68 and coming in, but
yeah, exactly. Yeah. Well, and that's just it. Really, like I said, our industry is just setting expectations, and you guys do such a great job of meeting with the clients, talking with the clients, doing conference calls. That's really where you shine, because you want to find out what's best for the client, not here's one product I sell. Exactly. It's not trying to, use the round peg into a square, or I guess a square peg in a round hole. That would make more sense. But that's essentially what people do. They go, I sell this one thing and it's going to fit everybody. And that's not the case. The interesting thing is I've done these illustrations, not for people who are in their working ages, but for, kids, like family members that want to build something for their child. And you always see the TV commercial, buy a whole life policy, $10,000 for, their grandchild. The reality of it is a $10,000 whole life policy endows at age 100, meaning the cash value equals what the death benefit is at age 100. So if I buy 10,000 a whole life, I will have 10,000 in cash, theoretically, at age 100. What does that mean that I'm going to have when I'm in my 20s? A few hundred, a few thousand. It's not going to pay for college, and and that's not realistic. But what I've done is I've actually taken these policies and I've put in $3,000 or $4,000 a year into a juvenile policy. For a family that has money to put towards their kids. And I defer those to retirement, just as a joke, to say, hey, if the parents paid, say a 7-year-old till they're 20 something years old, and then they stop paying on it, and then the child defers that to their retirement, it creates a retirement account of like, $70,000 to $100,000 a year for 20 years. And you're putting in very little because you have that time, to build it. You might have 60 years of potential growth before you take it out. But you can use these designs in really unique ways, either, utilize it for like, and I've done these for the, children that don't want to do the whole life policies. We've done these where they fund it, up to adulthood and then just let it sit and watch it grow, and then take distributions later on. Of course, they could take distributions at any time, but just to see what it would do and the impact of time on that money. But yeah, mainly what we're looking at are people who, they want to have extra money coming from somewhere. You could use this as a vehicle to take money out on down market years or following a down market years on your own investments, to allow those investments to recover and give you more money in the back end. And it's basically we call it mitigating risk, or you take a distribution on your life insurance and use that money on a year that your investments did poorly, versus taking it out of that that down year and then having to make that money back up. And it makes a substantial difference in how much money is left for your heirs. If you want to leave something to your kids or your grandkids, this is a way of strengthening your own portfolio, and not necessarily just taking a distribution every year, but having that money there to pull out on down years or following a down year in the market will increase your asset in the back end greatly, because you're allowing that money that was in the asset that took a hit to continue to grow in those years. And when you take it out of the life insurance policy, there's no factor on the market, right? Because we have that zero floor. So it didn't take a downturn. It just went to zero, but now you've got some money to pull out of there. Like I said, we could get into that, and clients that are interested in those types of concepts, we could show them, how much more money that's left, for the kids in the event that they pass away.
Yeah, that's fantastic. Because like you said, there are different strategies, right? Different situations, different strategies. You did mention like those 3 buckets, and you brought a great example up. Yeah, you have the 3 buckets, but you're not pulling every year out of those 3 buckets the same, like 33%. You're doing a strategic taking out of the tax-free this year because the market's down, and I want to let my my money that's in the market. I know you talked about the tax now, tax later, tax-free, but it's also buckets of like when to pull the money, like you just mentioned right now, which is fantastic.
Absolutely. Yeah.
Kind of went over quite a few mistakes that you have seen, like with the whole life and the loan rescue. Are there any other mistakes that you come in contact with that that's sitting and listening, and it's like, oh well, what about this? Something common.
I see a lot. Sometimes it scares me, to be honest, because the things that come across my desk, I just start scratching my head and say, why? But a lot of issues that people got themselves into as far as advisors, setting expectations is the main thing. We always tell people we're going to set the right expectation and give them a product that we believe is going to do what we've illustrated. The problem with some of it is, like the variable contracts that came out. Variable got a stigma because advisors, what they were doing is they were putting money in and trying to buy the highest death benefit versus the least, right? We try to solve for the lowest death benefit to grow cash. And what they were doing is they were using the hypothetical rate of return, and back then it was like 8% or higher, to offset the cost of insurance. So if you do that, you're not going to get 8% every year. Those policies usually would blow up earlier, meaning, originally I illustrate it to go to age 100, and now the client gets out into their 70s and the policy's requiring extra premium to keep it going, because we said your premium is $1,000 for your $500,000 death benefit, but you have to make 8% on that money every year in order for that $1,000 to pay for the cost of insurance. And that's not realistic. Right. It's not the right expectation. So that's another, thing that I see, or I used to see more of. A lot of those contracts have all lapsed because they, were bought years and years ago. And more of the contracts that have been coming across my desk have been just overloaned whole life policies where, once again, people weren't given the right expectation, and you see all that cash value in there. I mean, you put your money in for 30 years and you go, wow, I've got $200,000 in here. I'm going to pull 100 out and buy a boat, Well, the insurance company is going to charge you 8% on that money every year in most cases on that. And if you let it sit for 10 or 15 years, what do you think happens to the other cash that's sitting in there? The money has to come from somewhere to pay for the cost, right. And and if you're not paying premiums, the dividends are not going to support a higher loan rate. It just doesn't make sense. Math is math. If I make 5%,
numbers don't lie.
Yeah, 8%, it doesn't ever work out in your favor. Back in the day, they used to call Be Your Own Banker. There was books out there where you could utilize this, but that's when dividends were paying at a much higher rate. Loan rates were about the same, and you could create what's called a wash loan. So you make 8, you spend 8, it washes out, and then you're not eroding your cash value. And we don't see that so much. Now, with interest rates on the rise, who knows what the dividends will start to kick out. But, they've been going down over the last 30 years. And like I said, if you get credited 5 and you're spending 8, then it's never going to work out well for you. But yeah, I mean, those are kind of the main pitfalls I see is just, money that's in a life insurance policy is designed to be taken out over a period of time. And the reason being is you're allowing that additional cash that's in there to continue to grow. And if you take a small distribution, and that's the way we design it, right? We actually put, a life insurance policy together by just saying, how much extra income do you have to put into the policy? And then we run it into the illustration and we say, what amount of insurance can we buy the least amount? So we solve for the minimum non-MEC. We have an increasing death benefit as the cash grows because it hits what we call corridor, and it pushes the death benefit up on, it has to be a certain amount in order to stay within that guideline. And the money will grow over, say 15 or 20 years. Then we show this is the amount that if we get this hypothetical rate of return, this is the amount you could pull out from, say, age 66 to 86, right? We've done those designs. And if it says 35,000, then 35,000 is the expectation based on the rate of return and the money going in. Now, I will say this. The thing I love about, life insurance policies that like an index, even variable or any of them that have this hypothetical rate of return, once your money's grown and you get to that point where you're going to take a distribution, you call the insurance company up and say, based on the return I've received over the 15 years, how much can I take out from age 66 to 86? And they'll run you a real-time illustration saying, this is the amount you can pull and still keep a death benefit to keep this all tax-free. And that number may be higher or lower. It's never going to be the same as what we quoted because that's just not reality, right? We're guessing on rates of return and everything, but you can change things on the fly to ensure that you keep everything tax-free. And by that, I mean, if I get to the point of where I've grown the money and I have a new illustration saying I can take out $25,000 a year for the next 20 years, I'll take it out for 2, 3, 4 years. Then I'll call the company again and say, am I still on track to take this out? They can run you a new illustration and say, you know what? You can actually take a little more out. It's performed pretty well over the last 4 years. You could take out, maybe $500 more, or you might take out $500 less. There's not a big differential as far as the amount you take out in most cases and still have the policy run all the way out to mortality and have that death benefit payout in the back end and keep everything tax-free. So we recommend that people make these adjustments as they're pulling distributions, and that will ensure that these policies remain tax-free. The last thing we would want you to do is just call up a company and say, I want to pull out $150,000 of my $300,000, and then we'll just see what happens. That's that's going to get you into trouble every time.
Absolutely. So you mentioned a couple of times, some of the software that you use to help design these in the correct manner. How have you been able to stay on the cutting edge, I'll say, of the insurance industry with software, with knowledge?
Well, and that's why you want to work with, like a general agency, like Allegis is. We have access to, the carriers directly. The people that you associate with, obviously, you want to have people who, have been doing this for, a certain amount of time. You wouldn't want somebody that just started running illustrations a week ago and expect them to know, all the nuances and the things that you can kind of get yourself into trouble. But yeah, I mean, working with, 60 carriers and more, you really get an idea of who's got what and how it works. And it used to be where you'd have to go into each carrier's software and they were all different, and you'd run an illustration, then you'd go to the next carrier software and run an illustration. And you would do this, 20 times, and then you would compare all the numbers, and it would take a long time to come up with a design. Nowadays, we have software that I can put in basic client information, and it will actually itemize all the carriers as far as their death benefits, their premiums, their projected cash values, everything on one spreadsheet instantaneously. And then I can look at that and say, okay, out of these, carriers that we're running this particular solve on, these are going to be the best fit, and then go into the software and fine tune it. We even have access to the software where we can run all the total illustration all at once as well. So, I'm working with a group that really invests money into having the latest and greatest software that will benchmark carriers for us, so that we don't have to be that, well, I got to go through and run each one and then, basically look at all these illustrations that could be 30 pages long and try to compare the numbers. They actually kind of fine tune it for us now. And it does make things a lot easier, but you really have to know what you're running and why, So that's kind of the pitfall that a lot of people fall into, is they call somebody up and say, I want this, this, and this. And if you have somebody who's experienced, they'll tell you either that doesn't exist, or you're trying to put too many things into one policy, and here's a better way of doing it. Is you really want to have that expertise and experience behind you. And I think you guys do a great job of that, because it goes a long way to, one, give, the people the right advice, but also feel good about what you're offering and making sure that, what we offer is going to be there when they need it.
Yeah, exactly. Well, Jason, thank you so much for sharing your wealth of knowledge with us and all of our listeners, our cash flow hackers. We definitely appreciate you coming in. For anyone that is intrigued by what Jason has shared, give us a call at CQ Consulting. And since we work so closely with Jason, we would be able to set something up for us to all work together. If you have a policy, maybe you want to be reviewed, we'd be more than happy to do that. Or if you just thought, hey, that would be something that I'd benefit from. All right. Well, that wraps up this episode. Thank you for tuning in. As always, please join our Facebook group, Cash Flow Hacks, and follow our Facebook page, CQ Consulting Services. Thank you for listening, and we hope you enjoyed the episode. Thank you again, Jason, for being with us.
Thank you.